Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 12th of July. I'm Daniel Lam, your host for the podcast. Right before a media interview last week, I was taken aback by events at home, when all of a sudden I was told that I needed to keep full eyes on my kids for the following week. So when I was asked by the interviewer about the prospects for Chinese equities, my mind just went blank. And I ended up saying that Chinese equities is in an embarrassing kind of situation. Well, of course, what I meant was that Chinese equities were pulled in different directions by various forces. So first of all, Chinese equities are cheap in valuation. There is likely to be limited downside, with Hang Seng Index having strong support just above the 18,000 level. But there was a lack of catalyst to drive Chinese equities higher. Indeed, the latest China CPI and PPI inflation numbers indicate that deflationary pressures continue to dominate the domestic economy in June. So producer prices had the sharpest pace of decline since December 2015. Meanwhile, consumer prices were unchanged in June from a year ago, which means it missed expectations. These numbers continue to confirm the concerns that China's post-reopening recovery has been weak. Now, looking at history, back in 2015, which was the last time when deflationary pressures were as pronounced, the authorities responded with aggressive policy stimulus. Now, would they be stimulating the economy aggressively again this time? The Politburo meeting is an event that many would hope to deliver significant stimulus. Now, so far this month, the joint statement from the PBOC and National Financial Regulatory Administration was worth noting. It was related to properties, and it stated that financial institutions will be encouraged to negotiate with real estate companies to extend outstanding loans to ensure the delivery of homes under construction. Now, would there be more stimulus to come? Many would believe so, but equally, the Chinese policymakers may exercise restraint on policy stimulus because official GDP growth and job targets still appears to be within reach. But we need not only look at developments within China. After all, fund flows are international, and they do rotate between different asset classes. And it appears that there could be some rotation out of the hot US technology stocks, because investors may finally be chased out of their comfort zone due to hawkish Fed policies. And Chinese equities with their cheap valuation would most likely be a key beneficiary from any mild near-term vulnerability in US equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.